Hello, everyone, and thank you for attending week 2 of BFSG's 3-week fall webinar series, today covering charitable gifting. Before we begin, a couple of housekeeping items. There's a Q&A box in the Zoom menu for all of you logged in on the computer. As we go through the presentation today, which should be approximately 30 minutes, if you have any questions, please type them into the Q&A box, and we will address all questions at the end of the presentation. Due to compliance purposes, being on a live and recorded webinar, we will not be unmuting lines. So please type your questions in. And again, we will address all questions at the end of the presentation today. Should your questions be a little bit more personal in nature, we will provide contact information at the very end of the session today, and we would encourage you to reach out directly rather than asking personal questions on a live and recorded webinar. Again, the same registration link, as well as a link that we will send tomorrow, will allow you to view this entire presentation in its entirety on demand. So there's no reason to screen share or screenshot, taking pictures, etc. Again, you will be able to download the PDF slides via email that we send tomorrow, as well as watch the entire replay. Lastly, this entire series is the result of numerous surveys we've done through a number of webinar series. So we encourage everyone to let us know your thoughts on today's presentation, as well as the content and future topics you might like to see by filling out our 1 to 2 minute survey on SurveyMonkey. And then I would also pull up the chat box for all of you. I will post periodically a random link or two in the chat box that all of you might want to reference as we go through the presentation today. With that in mind, let me pass it over to our panelists for introductions. Paul.
Good morning, everyone. My name is Paul Horn. I'm a senior financial planner here with Benefit Financial Services Group. Thank you guys for joining us on today's webinar on charitable gifting. This year, 2020, has really been an interesting year. You could almost call it the year of 2 pandemics. We've seen an interesting separation as Wall Street has done really well. Stock market's done great, hitting all-time highs. Unfortunately, though, Main Street has been the exact opposite, with many individuals being severely impacted by the multiple closures due to the COVID restrictions. As a result of this today, we'll discuss further, but this dichotomy has really created a very important year for charitable gifting. We're lucky to have Sean Jensen presenting with us today. He's a wonderful individual, has incredible knowledge and experience in this area, and he's been an important resource for those of us here at BFSG. Sean, can you tell us a little bit more about yourself?
Sure. Thank you, Paul, and thank you for inviting me today and giving me the opportunity to speak on this topic. So I'm a relationship manager at Schwab Charitable. Schwab Charitable is an independent public charity that was established by Charles Schwab and Company over 20 years ago with a simple mission to help increase charitable giving in the United States. And we do that by supporting advisors like yourself and your clients to help them maximize their philanthropic impact with a simple tax-smart giving account known as the Donor Advised Fund account. My role as a relationship manager is to have a broader focus on charitable strategies and help advisors and their clients put together a plan that's best for them. My background, I was in finance for about 13 years and then took a left turn and went into the nonprofit industry, as I'd always been really interested in that sector, and worked in development and fundraising, and quickly realized that a lot of donors have a lot of passion in what they do and supporting the causes that are important to them, but they don't put a lot of planning behind their giving. So this job is really kind of a dream job for me because I get to work with individuals and families and just help them support whatever cause is important to them, but help them do it in the most tax effective way possible so they can ultimately support their charities with biggest impact.
Thank you so much, Sean. And then Chad, can you go and kick us off with our first poll?
Yep, I can. So for all of you, this is going to be the first of 3 interactive polls that we have for you today. The first poll is just to gauge the audience today as we prepare a presentation, is to think through, what are the different ways to give? And so if you're currently gifting already, how do you currently gift? I'm going to launch polling right now. I will leave it up for about 20 seconds. The option are I write a check or I give cash, I ask my advisor or CPA, I already have a good plan in place, or that's why I'm here today. Please share your thoughts and I will share results after the poll is concluded. With that, let me conclude polling right now, and I will share results with the group. And we have about 70% that say today they already write a check or they give cash. About 3% say they ask their advisor CPA for advice. 8% say they have a plan in place, and almost 20% say that's why they're here today. So today's results or today's presentation should be very valuable for most of the audience. With that, let me give it back to our panelists.
Perfect. Thanks so much, Chad. And everyone, I apologize. My camera is off today. Normally I have my camera on so you guys can see my wonderful smiling face. I'm just getting over the flu. I was tested. It's not COVID, we know that, but just don't want to distract anyone being a little sick today. So with charitable gifting here, you guys, the most common way that people do gift is check or cash. I'm glad you guys aren't here because you'll get a lot of important advice. It is always good to talk with your financial planner or your CPA. As you guys will learn today, there may be other avenues for gifting that may be more tax advantageous for you guys. Today's section can really be broken down into 4 areas. We'll be talking, just kind of doing an overview of charitable gifting. Then we'll be talking about what assets to consider gifting, how to make that gift, and then finally, the best way to handle taxes when you're choosing the appropriate strategy. Let's go ahead and start with the overview of charitable gifting. Just keep in mind, you guys, that charitable gifting can come in many forms, and this can include money, which is what we've talked about so far. But beyond that, gifting can include your time, gifting time to, help feed the homeless at a food shelter, or could be items like clothing and toys. In fact, this time of year is a great time to get a head start on spring cleaning and make charitable donations of clothes, blankets, toys, and other items that can benefit those that are less fortunate. In my house at this time every year, my 4- and 6-year-old understand that before Christmas comes, that they have to go through their toys in their room and they donate the toys that they no longer play with, because there are kids out there that may not be as unfortunate and can enjoy playing with those toys. So it's even a great time to teach values to our young ones. Sean, can you talk to us about the elements of a charitable plan?
Yep, so this is going to be a high-level overview of how a charitable planning discussion might look. The first thing with charitable giving is understanding, just like a financial plan, what are the goals and objectives of that family or the donor? Are there values that they hold in their family where giving back and supporting others in need is really important to them? Is there a specific cause, whether that's climate change, homelessness, something that they're very passionate about that they'd like to make an impact on? We often speak with clients that are looking towards estate planning and how they want to leave a legacy, what their legacy will be, and if charitable giving will be part of that. And then also, of course, involving the next generation in the tradition of charitable giving. So kind of bucket that in the goals category. Then we step over and look at resources. So you have these goals of charitable impacts that you want to make. How are you going to fund that? Obviously you're investing your assets, you're holding cash, but you're also holding other positions. So what resources are going to be the most advantageous to fund your charitable giving? And also, when will it be most important for you to fund that charitable giving activity? Oftentimes that's not always the same thing. The most tax benefit that somebody will probably receive is going to be during years of highest income. But oftentimes we see that our clients have time and energy to put into their charitable giving later in life during their retirement years, for example. So it's good to understand those components. Once we have a bigger picture of what the client's trying to achieve and what resources they have available to fund those goals, then we can easily transition into what kind of vehicle or vehicles for charitable giving are we going to put into place so that they can actually achieve those goals.
Thank you so much, Sean. I know when I'm working with a lot of our clients, a lot of time is spent on the goals area here because a lot of times we'll uncover goals that maybe clients don't even really realize or think about. So for example, the Great Generation, those that served in World War I and World War II, grew up with some of the best financial habits of any generation. But unfortunately, in the way they grew up, they were taught not to talk about money. So they haven't been as open with their children and teaching them the same goals and habits. And so while you're living and you're thinking about, your charitable planning goals, just keep in mind that it becomes an excellent opportunity to have discussions with your heirs, with your children and grandchildren, to help instill in them the same value and the same work ethic that was so important to you. Because when I talk with many clients about this, what I realize to them is, yes, they want to leave their their heirs with money. What is most important is they want to leave them with the same values that they hold.
Yep, and we talked about 2020 being kind of a crazy year, a year of two pandemics and a lot of things going on this year, but it's shaped up that 2020 is a particularly good year to give. First, probably don't need to go into too much detail here, but the need is unprecedented. We're obviously living through what we hope is a once-in-a-lifetime global pandemic, but there's also some market volatility. There was a lot of political uncertainty and social unrest. For us on the West Coast, we're also experiencing wildfires and other natural disasters. So there's certainly a need out there for charitable support. Second, and what we're seeing that we're very happy about is donors are reacting, and they're reacting with great generosity. I can only speak so far through 2020 from our personal experience at Schwab Charitable, but we've had the most years since our founding in 1999. Our donors have, in those 6 months, contributions and gifts out to charities have surged by almost 50%, both people putting accounts, the donor advised fund, but also granting money out to charitable organizations. And for our fiscal year 2020, which ended in June 30th, our donors recommended more than $3 billion in grants, which is a new record for us. And then finally, we've got the need, there's generosity, but we also find ourselves in a tax market that is actually ideal for increased charitable giving. The market's been volatile this year, but major equity indices have reached all-time highs. People still are finding that they have appreciated assets in their portfolios, which make great gifts for charitable giving. Also, there's some certain tax incentives that have come about in 2020, specifically under the CARES Act. But also looking back at the end of 2018, when Tax Cut and Job Act came out, the charitable deduction remains one of the most controllable and powerful deductions at our disposal. So charitable giving really is shaping up for a great year in 2020.
Yeah, and you bring up a good point there that we'll touch on a little bit here, Sean. With the charitable gifting being still part of that itemized deduction, it is the one that we can control to see if we're going to take the itemized or standard deduction, and we'll talk more a little bit about that. We'll talk about that in a later slide.
So,
all right. So when we
no, go ahead. Sorry, Paul.
Oh, no. Okay. When it comes to charitable gifting, an interesting stat here is when we look at the gifting for all of 2019, 69% of all gifting, or about $309 billion, came from individuals. So individuals making gifts represent 70% of all giving done last year. Foundations, bequests, and corporations were much less. So this is why it is so important for individuals that are charitably inclined to really continue to give so, because they're the biggest driver for charitable giving.
Mm-hmm. As a whole, this charitable giving landscape, this data is from 2019, shows that the giving was almost $450 billion in our country. And as you mentioned, Paul, majority of that was from individuals. And this data comes on the heels of the Tax Cut and Jobs Act, where the limit for the standard deduction nearly doubled. And there was actually a lot of fear and speculation that charitable giving would decrease because those who used to itemize and now fell in the standard deduction category wouldn't have that tax incentive to continue to give. So it's really refreshing and nice to see that people still did give. And we see that, tax incentives aren't always the driving factor behind a individual or family's desire to give to charity.
Sean, can you talk to us a little bit how life events can trigger opportunities for a conversation?
Sure. These are kind of some different buckets or categories of lifetime events or tax events that might occur in a family's lifetime that could trigger a charitable giving discussion. And that poll was really refreshing to see that Chad put up. One of the things that we at Schwab Charitable really encourage people to do is to speak with their financial consultant, their financial charitable giving, because if charitable giving is important to you, it should be part of your broader financial plan and big picture. So with that said, we'll see different things come around when charitable giving conversations are triggered. Annually, that comes around tax time. If somebody's looking at their tax situation in a given year, if they've had a high income year or just, their regular income year, but they're looking for ways to reduce their income taxes, charitable giving is going to be, again, one of those controllable deductions at your disposal. Annual giving is also just part of the fabric of what we do. So many families are going to want to give to charity on an annual basis. So they're going to want to understand what the most effective way to do that is and what strategies they can put in place to receive a tax benefit for those giving activities. Second bucket is asset appreciation or concentration. So we're going to go into this topic in further detail, but essentially non-cash assets make great gifts from a tax perspective to fund charitable giving. And so when working with your financial advisor, they might find opportunities within your portfolio. If you have a highly appreciated concentrated position, those could be identified as great assets to fund charitable gifts.
Yeah, and when I'm working with clients on this one, Sean, one area that I commonly see would be if you have stock options in a company and those stock options accumulate over time, those can be a great resource to use for charitable gifting.
Absolutely. Definitely thinking outside of just that cash bucket can open up a lot of opportunities. We then also transition into life transitions. Again, I was speaking earlier about high income years might be during your working years, but giving years might be different later on in life. So preparing for that, how you're going to take advantage of tax situations. But you may also have, besides retirement, there could be other life events such as, or other big liquidity events. And so incorporating charitable giving or taking advantage of that event to fund future giving could be very advantageous. And then finally, charitable oh, go ahead.
Oh, sorry. The major life transition here. I helped a client sell a business about 2 years ago. Client was in the mid-50s, sold their business for $40 million. We talked with the client. They were going to retire for a few years and then probably start another business at some point. But they were very charitably inclined. And because they sold that business and they had that huge windfall in 1 year for $40 million, we had worked with them setting up some charitable gifting strategies that we'll talk a little bit more about using that donor advised fund, where he put in about $8 million in that donor advised fund. And by doing that, he's able to save tens of thousands in taxes by making that charitable gift in that year when he had that major windfall. We'll talk a little bit more about that in a little bit. And then finally, estate and legacy planning as well can be an important time. So if you're someone that has an estate tax issue, this will become more commonplace as we expect to see we'll see a reduction right now. The exemption is 11 million, and it's expected in 2026 to drop back to 5 million indexed for inflation. But to help get assets out of an estate is another reason to consider charitable gifting, and helps you leave a charitable legacy for the family. So again, you can do this in a way that can be set up so it leaves a legacy not just for you, but for your kids and grandkids to help use for charitable gifting. All right, let's go ahead and talk about choosing the most appropriate asset to gift. As we've mentioned before, gifting can be complex and cash may not always be the best option.
Yep. And you know what, that poll that we presented earlier was very consistent with how charitable giving takes place across our country. We definitely see that most Americans write checks and use credit cards to give to charity for their annual giving purposes. But for most investors, this is not the most tax effective way to give. Quite simply, the reason behind that is the IRS has made it very advantageous to give appreciated investments or assets to charity. So if you have appreciated investments in your portfolio, if you have other assets that have low basis and are very highly appreciated that have been held for more than 1 year, you can donate those assets directly to charity. You claim a fair market value deduction and avoid paying capital gains taxes when those assets are sold. So you as the donor are able to lower your tax bill and, depending on the cost basis of your shares, increase the amount available to give to charity by up to 20%. And because the charity itself is a nonprofit, they're tax exempt. So when they sell or liquidate those assets that you've gifted to them, they don't pay any capital gains taxes either. So it's really a win-win both for the client and for the charity. You know, we talk a lot about publicly traded stock and investments within a portfolio because those are very easy assets to identify. They're easy to transfer to charitable organizations, but also there are opportunities for other assets such as shares in a privately held business, real estate, cryptocurrency. There's a lot of opportunities out there for people to look all the way across their spreadsheet to see highly appreciated assets that could be identified as good candidates for a charitable gift. So there are, you know, benefits both of giving cash and non-cash assets. The benefit of giving cash is pretty obvious. It's easy. It's going to be the easiest, quickest way to give money to a charitable organization. So this could be done by writing a check and mailing it to a charitable organization, going online and using a credit card. It's a one-time gift. You receive the deduction immediately when you make that gift, and the charity obviously receives full control of that asset as soon as you turn it over. I think Paul is going to talk a little bit about deduction limits in a moment, but the cash deduction limits for gifts of cash are higher than that of stock or other highly appreciated assets. And then for the charity's perspective, every charity can accept cash or credit card. It's very easy for them. It's cost effective for them to accept cash, and it's immediate. So they like that as well. However, you know, looking for those who are planning for long-term charitable giving strategies, there are many benefits of giving highly appreciated stock or highly appreciated assets. So again, if you've held that asset that you're contributing to charity for over 1 year, you can eliminate the capital gains tax on that gift. The charity can hold the stock or other asset when they receive it, so they don't need to liquidate it right away. When they do liquidate, there's no capital gains event, but they can hold it for future growth as well. But for also looking back from the client's perspective, you know, there's certain clients that we often speak with that have a concentrated position. The financial advisor has been kind of urging them, you know, this would be a good time to get out of this stock, but there's hesitancy because they don't want to pay the capital gains tax. Well, using that stock to then fund your philanthropy will, you know, it basically negates that hesitation or need for, you'll alleviate yourself of any capital gains tax consequences. So there's a lot of great benefits.
Thanks so much, Sean. And then when we talk about the tax deduction limits here, it is important because if you're someone that's giving a large amount to charity, you can write off more if you're giving cash as compared to a long-term capital gain property like stock. So for example, here in 2020, they actually have a one-time exclusion of up to 100%. So if you make $100,000 this year and you want to gift $100,000 to cash, to charity, you can actually zero out your income. Normal years, so starting next year and beyond, it'll be back to the 60% threshold. So again, if you make $100,000 this year, you can gift more in cash than 60,000, but if you gift, you're only allowed to deduct up to 60,000 if it's a cash donation. And if you're taking a stock donation, it's 30% of the fair market value. So if you're, again, making 100,000 and the fair market value of the stock is, let's say 30,000, well, then you can deduct the full amount. So if you want to give a larger amount, let's say you make 100,000, but you want to gift 65,000, the question may become, what's the best way to do that? Most people would think right away, just go ahead and give all the cash and be done with it. But it actually might make sense to first hit the 30% of the long-term capital gain stock. So get that appreciation out of your portfolio, help the portfolio get rebalanced. So that would be 30,000 if you make 100,000 this year. And then you still have 35,000 to still gift. The remaining portion of that gift then could come from cash. So when you're making the gifts here, you can fill multiple buckets. You're not just limited to the lower of these numbers or anything like that. And then Chad, can you go ahead and start us with our next poll?
Yeah, thank you, Paul. So the next poll, being on this topic, stock versus cash, is to kind of think through what is the tax benefit, right? So assuming that you bought a stock and it has a $5,000 basis, how much in taxes might be saved by gifting $50,000 worth of that stock today instead of gifting $50,000 in cash? So let me launch polling again. Again, I'll leave it up for about 20 seconds, assuming a $5,000 basis. What is the potential taxes and saving by gifting $50,000 in stock versus $50,000 in cash? So with that, let me close polling. And again, I will share results with the group. We have over 40% saying 16,000, about 30% saying 12,000, and then an even split 14% each for 5,000 and 8,000. With that, let me stop sharing results and I'll give it back to Paul to share the actual answer.
Thank you so much. Chad? So when we look at a case study here, and in this example, assuming 50,000 is being gifted in appreciated stock, if there's a cost basis of $5,000 on that stock, so that stock was bought for 5,000, but now it's worth 50,000, assuming a 15% tax rate, what we see here is additional savings is actually $8,000. So I love the optimism from you guys there, but most of you are a little bit high. What we see here in option one is if they take XYZ stock, let's say that they take this 50,000, they sell it, and then they gift the cash from the proceeds. If they sell the stock, they're going to trigger $6,750 in taxes. So after they pay the taxes, they're going to give to the charity in cash $43,250. So they would save a total of $3,600 in taxes. But if they instead don't sell the stock, but gift the stock directly to charity, the charity gets all $50,000. The charity can sell that stock if they choose to. They don't have to worry about any taxes on that. But because of that, the charity is going to get an additional $6,000, right? They're getting 50 grand instead of 43 grand. And the individual will have a tax savings of $12,000 instead of $3,600. So the total savings for the individual is about $8,400 in that example. So this is just a great example of why it's so advantageous to gift appreciated stock.
Yep.
So let's go ahead and talk about the best vehicle to gift when you're making gifts.
Yep. So, we've talked about, the first part of that charitable planning conversation bucket where we're going to talk about goals, et cetera. Conversation is about what assets to use, but now how are you going to actually transfer those assets to the charitable organization? So sometimes when considering this, the choice of the charitable giving vehicle might oftentimes be related to the time period in which somebody wishes to give, and also the frequency and complexity of those gifts. So for those who might be giving sporadically once a year, here and there, it could be cash or just a publicly traded stock. Giving now might be the best option. Obviously, for cash gifts, you're just going to write a check or make a credit card contribution to a charitable organization, and that's going to be sufficient if you want to just, it needs to be done right away. It might not be a large amount, and the completion timing needs to be immediate. A stock transfer can be executed by actually transferring stock from your portfolio directly to a charitable organization. Now, we've talked about the tax benefits of that, but mechanically what generally would need to happen is a client would call up their financial advisor and ask them to transfer the stock over to the charitable organization. The organization would then in return issue a tax receipt for the charitable gift. So you could see if you were going to do 5 or 10 gifts per year, that could become a cumbersome process from both transferring perspective, but also from a record keeping perspective. The second bucket is for those who want to give over time and might be making more frequent gifts, might be spread out over time. The years in which they need tax deductions might be different from the years they want to give to charities. They might look at an endowment vehicle, such as a donor advised fund or a community foundation, setting up a private foundation, or if they're in their retirement years, using their IRA accounts to fund their charitable giving. And we're going to go into more detail on those three items next. And then finally, there is an opportunity to set up charitable trusts or charitable gift annuities. And these types of vehicles allow individuals to receive partial tax deductions up front when they fund a trust account. And then assets can both be distributed to charitable organizations, but then there's also an opportunity for an income stream to be delivered to a non-charitable beneficiary, which could be the individual who sets up the trust or some.
Yeah, and I love this slide. So much time could be spent on this slide, just covering all the different basics here. One thing I'd remember, guys, is this is, again, the annual gifting is typically the green, your give now. This is the gifting that you guys are doing now on an annual basis and want to continue to do on an annual basis typically. And then when we talk about having a charitable plan over time, especially if we're looking at doing some sort of legacy planning, trying to reduce estate taxes, or maybe set up, teaching values to heirs, and helping create a family sort of gift over time, we then begin to look at these other strategies here. Again, the most common ones being these blue items, the donor advised fund, foundations not as much anymore, and the QCDs, qualified charitable deductions.
So each of these giving vehicles listed on the screen right now are considered endowment vehicles. They work very similar from a tax perspective in that when you contribute assets to these types of giving vehicles, you receive a deduction for a charitable gift when you make a transfer into these accounts, whether it's a private foundation, community foundation, or donor advised fund account. But then these giving vehicles provide a flexibility that you receive the tax deduction when you put the money in, but you don't need to grant the money out to charity right away. It can be done at a different year or future date. So this provides a great timing flexibility for individuals that want to front load their charitable giving during high income years or during liquidity event years, et cetera. And each of these giving vehicles have different attributes that might make them attractive. And we'll also see people use a combination at certain times if it makes sense for their families. Private foundations have the most notoriety, so people are familiar with the term. As Paul just mentioned, they're becoming less common for people to start private foundations. There are many that are still in existence and do a lot of great work in charitable gifting. These have also, as Paul mentioned earlier, some lower tax deduction limits because in addition to charitable giving, they provide some additional flexibilities. The ability to pay family or staff that might work at the foundation, support scholarships where you're picking individuals instead of a charity. You can pick an individual to receive a scholarship from the private foundation. You can support loans to charities, et cetera. So there's a little bit more flexibility involved in a permit, but there are also some additional expenses that go along with setting up a private foundation, and absolutely some administrative responsibilities as well. A private foundation is its own legal entity, whereas to the right, you see community foundations and donor advised fund accounts. These are accounts that you set up at an institution. So you're not setting up your own legal entity, you're simply setting up an account at one of these institutions. So the tax setup works very similar in the sense that you can contribute assets to your community foundation account, to your donor advised fund account, receive a current year tax deduction, have funds invested, and then give out to charities at future years. Both of these vehicles have a lower cost. Administrative burden is simplified and streamlined by the provider of these types of accounts. There could be some more privacy involved with these types of accounts. And again, similar to the slide previously, we could spend 15 to 20 minutes just on this slide right here, but these are different giving vehicle options that are available to people who want to set up a longer term giving strategy. And I think next we're going to spend some time specifically on the donor advised fund account.
Yeah, I had one client I worked with that was religiously inclined, but their kids were not. And their kids, they wanted to have their kids active in the charitable discussion. So in that client, what they ended up doing here was using two separate buckets. They made some gifts to a community foundation that was shared the same religious views that they did. So that way they could make sure that money was used for the religious purposes that they were hoping. But aside from that, they also put other money into a donor advised fund. And so what they did here is that individual kind of controlled the donations on the community foundations that were meeting their religious views. But then the donor advised funds, they worked more in conjunction with their kids to make donations to charities that the kids were that were involved with as well. That was important to them. So that's just one example of how at times you may want to use multiple vehicles.
Many on the call may be familiar with how the donor advised fund or DAF works, but we'll do a quick refresher here. So clients can open a donor advised fund account at various financial institutions like Schwab, Fidelity, Vanguard, et cetera. And each of those institutions has their own 501c3 setup, which is where the DAF is housed. The importance of this is that donors will get the same tax benefit when they contribute funds into their DAF account as they would when they give money directly to their favorite nonprofit organization. I've spoken on this, but the main advantage here is that the account with the DAF account is that clients can get the tax deduction in the year that they need it most, and then give money to charitable organizations they care about when it's right for them and for the organization. So we really like to say that these types of giving accounts allow people to separate their tax strategy from their giving strategy. Once the account's opened, clients can contribute either cash or non-cash assets into the account for a current year tax deduction. For non-cash assets contributed that have been held longer than a year, the client receives a deduction based on the current value of the asset and will not pay any capital gains taxes. So I would say about 70% of what we receive into our donor advised fund account at Schwab is publicly traded stock, but we do still receive cash for various reasons and also other assets as well. Once the assets are in the donor advised fund account, clients have the ability to invest them for long-term growth, and they'll grow tax-free. So while you're waiting to grant out the money to charitable organizations, the value of your DAF account is actually growing, making more money available for future granting activity. And as I mentioned on the previous slide, because this is an account and not a legal structure like a private foundation, easy to set up. There's no fees, whether it's Schwab or another institution. There's no fee for setting up an account. of a donor advised fund account, the DAF provider is going to handle all the record keeping for you. So a lot of our clients that do give annually and have either making stock transfers directly to charities or cash gifts directly to charities, they found it burdensome to keep track of all their grants, collecting those tax receipts from the organizations. We remove that challenge. So when you make a contribution to your donor advised fund account, that's when the tax event occurs. So contributions into the DAF create a tax receipt from the donor advised fund provider, and that's what you'll use to obtain your tax deduction. Moving forward, as you're granting money out to charitable organizations, the DAF provider itself will be responsible for all the record keeping and will obviously provide that information to its account holders. So it really is a turnkey giving solution. A lot of people focus on the tax incentive of the donor advised fund or charitable giving vehicles like this. But really for people who are engaged in charitable giving annually or have a long-term giving strategy, just the mere convenience of these types of accounts can be more beneficial than anything else. So one of the things I like to say is that the donor advised fund is extremely flexible. It provides that flexibility from a timing perspective. And it's also very flexible in making gifts as part of a legacy plan. So the donor advised fund account itself is a 501c3, and it can be named as a charitable beneficiary. So it can be the charitable recipient of a charitable trust, of a will. It can be written in as the charitable beneficiary in your trust, life insurance, etc. Anytime you open it's going to have its own succession plan. So it's a living account that can go on for multiple generations. So essentially, what would happen to the funds within a DAF account once the last account holder passes away? The DAF provider is going to follow the instructions that have been provided to them. So donors can choose charitable beneficiaries to receive outright distributions from their account at their passing. They can name successor donors to take over the DAF account. So that could be children or other loved ones that would take over the DAF account and do the gifting moving forward after the last account holder's passing. But there's also a legacy plan where charitable beneficiaries can be chosen, but instead of receiving an outright distribution, gifts can be distributed to charitable organizations from that DAF over an extended period of time, which will extend the giving tradition of that family over many years. So again, by using that DAF account as a charitable beneficiary in your trust, it can essentially be that asset, which will maintain your control over how and when charities are going to receive assets and what information will be associated with those gifts that they receive. Another way that the great thing about the donor advised fund, guys, is we have a lot of flexibility in terms of how it's being used. And the gifting doesn't have to be done. It can be done either while you're alive and making the gift, or as this slide shows here, it could be done upon your death. So the charitable gifting strategies that we're talking about, guys, can be done while you're living, or if you want to do it at your death, using something like a donor advised fund is another way that can help do that. All right, and then we're going to move on to section 4 here, talking about taxes and things to consider there. So for those who typically do not itemize, they're taking the standard deduction each year. These are some strategies to consider. First, in 2020 only, as a provision of the CARES Act, for those taking the standard deduction, you can qualify for a $300 above the line deduction for cash gifts made directly to an end operating charity. So that excludes donations to giving vehicles like a donor advised fund or private foundation. But if you're taking a standard deduction, you're still eligible in 2020 for a $300 deduction for cash gifts. Second, if you're taking a standard deduction and have been for the last few years, but charitable giving is something that is part of your annual practice, you may want to consider bunching or clustering your giving to achieve a tax strategy that will allow you to itemize in certain years and take the standard deduction in other years. And we have an example of that on the next slide, how that works.
Yeah, so bunching's a really cool strategy here, where essentially what you're doing is you're going to be front loading your gifting 1 year and then not doing the gift the next year. So as an example here, what you may have here is a client that has, total deductions of $13,000 plus their charitable giving of $10,000, but so they're only going to get to a total of $23,000 for their gifting, for their itemized deduction, but the standard deduction for them is $24,400. So since the standard deduction amount is higher, they don't get any benefit from the itemized deduction or from that charitable gifts that they're making. They're not seeing any tax benefit from it. So instead, what they can do is bunch them. So instead of doing $10,000 every year, you do $20,000 one year and nothing the second year. So by bunching the gifting in 1 year, so now you have $20,000 plus the $13,000 in other itemized deductions. Now their total itemized deduction becomes $33,000. Compare that to the standard deduction of $24,800. So what happens is 1 year they're going to take a $33,000 itemized deduction. The next year they're just going to take the standard deduction since they're not doing any sort of charitable gifting. And over a 2-year period, this is going to give them a total of $57,800 in deductions versus just doing the standard deduction each year. It gives them only $49,000. So they'll get an additional $8,600 of deductions over a 2-year period. I'm working with a client now where we're looking at this bunching strategy, very similar situation, where by making these donations for them, we'll be doing about $26,000 per year. But instead of giving the money directly to charity, it's going to go into that donor advised fund like we talked about, so they can control that gifting over a multiple year period, and they're not having to give all that money directly to charity in 1 year. So there's many strategies here that you guys can implement when you work with an advisor or tax advisor to help meet your gifting needs while still getting the maximum tax benefit.
And
so if you're someone that, oh, sorry, go ahead.
For those who already do plan to itemize, there are certain giving strategies that are important to consider in 2020. But most importantly is realizing that the charitable deduction remains that one most powerful and controllable deduction at your disposal, and it can help you offset any tax burdens that you may have experienced this year. So that could be capital gains tax, if this was a large income year, sale of a business, or Roth conversions. Again, using the charitable deduction to your advantage, funding your charitable giving with highly appreciated assets, and basically doing those same activities that we've been speaking about throughout this presentation. All of these can be incorporated into your giving strategy. And in the environment we find ourselves in this year, they may make a lot more sense than other years. But again, most importantly, financial advisor about your tax situation, about the positions within your portfolio, about any transactions or other events that have occurred in your life so that a plan can be put in place.
Yeah, and if you guys remember, for those that were on the presentation last week where we talked about year-end tax planning, we had that slide that talked about if you're in a year, if 2020 is a year where you have higher income than normal, some strategies to utilize. These would be the similar strategies as we discussed there. If you want to learn more about that, please contact us, or please feel free to listen to the replay of last week's webinar. And then for individuals that are age 70 and a half or older, they have a very unique opportunity where they can actually gift up to $100,000 out of a tax-deferred retirement account. So this would be like a traditional IRA or a 401k or 403b. What the IRS allows you to do is make what's called a qualified charitable distribution. It's known as a QCD for short, where the money comes directly out of the IRA and goes directly to the charity. And if you do this up to $100,000, you get a dollar for dollar deduction on that. So it does not create any sort of taxes for you guys. And the qualified charitable distribution is a great strategy for those that are subject to those RMDs, those required minimum distributions, if you don't need all the money. Because remember, at age 72, the IRS requires you to begin taking money out of your tax deferred account. So let's say they require you to take $50,000 out of your retirement accounts, but maybe you only need $20,000 to live off of. That remaining $30,000, you could just gift to charity. That would, using a QCD, that would satisfy your RMD for the year, and you would get the tax benefit there because that money's coming out of your IRA, and you're not having to pay any sort of taxes on that. That money's going directly to the charity, tax-free. So QCDs are great for individuals where they have RMDs larger than they need, and QCDs are also good for individuals that are taking that standard deduction. Because if you're taking that standard deduction each year, if you do the cash or stock gifting, you're not going to get that itemized deduction, but you do still get the tax benefit by doing the QCD. So if you're retired over the age 70 and a half, and you're taking the standard deduction, qualified charitable distribution can be a very valuable strategy for your charitable giving needs. And then when we compare, go ahead, sorry.
A question we get oftentimes is QCD, as Paul just said, is such a great option for funding charitable giving. It's for those in their retirement years, especially if they're required to take that distribution. But then they also may be looking at their portfolio and seeing highly appreciated assets, and they're going to wonder which option is the better one to take. This is certainly a conversation worth having. Everybody's situation is going to be a little bit different, depending on the motivation that there may be to liquidate an asset. Again, if it's a concentrated position that might be creating more risk in a portfolio, that may be an attractive option or reason why you may make a gift of that appreciated asset versus doing the QCD. But there are the equal benefits to be weighed for each of the two strategies. In addition to speaking with your financial advisor, also seeking tax guidance is also good advice when considering whether a QCD or a gift of an appreciated asset is being considered. And I'm sure Paul can attest that he's probably received this question multiple times from retirement age clients.
This is a very common thing that we compare the advantages of both strategies for them, and certainly work with a CPA on that. Finally here, I just want to go through an example for one client that we had earlier this year. For this client, they had about $50,000 in stock options that they had to exercise this year or they were going to lose them. And so that's great, but what happens is with those 50,000 stock options, that's treated as taxable income for them. And they're in the highest tax rates for federal and state. So on a $50,000 stock option, they're going to pay roughly $24,000 or $25,000 in taxes. So to help offset that, we had talked with them about if they were charitably inclined, which they were, we helped them set up a donor advised fund where they exercised the stock options, but they also gifted $50,000 in a concentrated stock position that they had from stock options from previous years. And so by them exercising the stock options for $50,000 and then gifting $50,000 in stock to a donor advised fund, they were able to take advantage of all the stock options with zero tax liability. So again, this just shows the benefits of doing charitable planning and how it can help you immensely from a tax perspective. Thank you guys so much for attending today's webinar. In just a few moments, we're going to move to questions and we'll have Chad lead that. If you guys have not already, our final part in this series will be next week. It'll be on distribution strategies in retirement. I would encourage you to sign up for that if you haven't already. If you're interested in learning more about establishing a donor advised fund, how to do those qualified charitable distributions, or maybe how to talk to your family about charitable gifting and setting up a family mission statement, please feel free to contact us. That's going to be financialplanning@bfsg.com, and we're happy to help you guys. Thank you so much. And Chad, can you start us off with our questions?
Thank you so much, Paul and Sean, for a great presentation today. Again, before we start the Q&A portion of this event, I'd like to thank anybody who drops off the presentation today. I know we are coming up on the top of the hour for attending today's webinar. If you pull up the chat box, I did post a few links for everybody to view. The first is a link to a 1 to 2 minute survey to let us know what you thought about the topic today. The second is a link to today's slides. So if anybody would like to download the slides for your own records, that link is available as well. The third link is a registration link for next year or next week's distribution strategies in retirement. I know most of you already do have a flyer that has that registration link as well. And then the last link is to our website, in the back end, BFSG University, which does have the registration links for most of the historical webinars we've posted over the last year, including last week's year-end tax planning, but also our summer webinar series and Social Security, Medicare, estate planning, etc. So now I do have a number of questions, including a comment from a friend of BFSG, another charity, Mary's Path. So let me start with the questions. First, the comment from Mary's Path. Just as a note, we talked about giving items and clothing and etc. And there is a note to definitely check with the charity before you reach out to donate those goods. And that due to the current COVID-19 situation, not all charities are able to accept those types of goods right now. So it's definitely worthwhile to reach out, make sure that they can accept those goods before you just show up to drop them off. With that, the first question I have is, can I carry forward charitable deductions? I can't use the year of the donation. And I think this might speak to the donor advice fund a little bit, but I'll let Sean and Paul answer that.
Yeah, unfortunately, so there is a such thing as a carry forward on charitable donations. But where those carry forwards apply is if you are gifting more than these tax deduction limits. So if you remember, I gave the example before is if let's say you make 100,000 for the year, but you want to give, let's say, $45,000, but you give it all in stock. You would only be able to deduct 30,000 because that's 30% of the fair market value. So you would have 15,000 in stock that you donated that you can't use as a deduction in that year. Those can be carried forward to another year. Now, if you are going through your deductions, and let's say that you make a charitable donation, but it's not enough to get you over that itemized deduction. So instead of itemizing, you choose the standard deduction, you are not able to carry forward those sort of charitable contributions. It's kind of a use it or lose it. So if you're itemizing, you can carry forward if you're over these deduction limits. If you're taking the standard deduction, there unfortunately is not a carry forward on the charitable contributions.
Thanks, Paul. So the next question, I know we do have people listening in nationwide. The next question is specific to some people in California. Is how has the flat tax mortgage write-off affected charitable giving in California with some of our clients?
I'm going to have to circle back on that one. I'm not quite sure what they mean on the flat tax.
If I had just added any insight, the charitable giving deduction would be, obviously there are some capped deduction categories, and certainly mortgage interest has been included in that, but charitable giving has not. So you're able to control the amount you give to charity, and as long as you're within those deduction limitations of 30% for non-cash, 60% for cash, you're able to keep those gifts under your control.
Awesome. So next question is, it's going back to slide 18. Can you give a little bit more detail on the $300 deduction beyond the standard deduction that we discussed?
Yep, so that's for 2020 only. It's part of the CARES Act, which was passed this year to help encourage charitable giving as a result of coronavirus. And so again, there were two different cash provisions that were made as part of the CARES Act. One was for those who do not itemize. They take the standard deduction, gift up to $300 per household, to charitable organizations and receive an above the line deduction. So you're not itemizing, but you're still going to get a $300 deduction any cash gift that you made to charitable organization. The other provision of CARES Act was for individuals who do itemize, and they can make cash gifts to charitable organizations for 2020 only. And instead of being held to that deduction limitation of 60% of their AGI, they can deduct up to 100% of their adjusted gross income in 2020 for cash gifts that are made directly to charitable organizations. So those were the two main provisions of CARES Act to increase charitable giving.
Thanks, Sean. Our next question, and I think this really goes out to both of you. I think the answer is definitely yes, is do we offer services regarding holding stock for nonprofit organizations?
Yes, we do.
And so a reminder for everybody, I got one more question really quick. The last question, so there is a Q&A box for anybody that does have outstanding questions left. Please type your questions in. Otherwise, the last question I have today is, can I put a QCD into a DAC? And it might be worth for Sean and Paul to define both those terms again. I know we have talked about them, but we didn't talk about the DAC yet today.
Okay. So a QCD is that qualified charitable distribution. This is the money that comes out directly out of an IRA, goes directly to the charity. This is on tax deferred accounts like a traditional IRA or a traditional 401k, and you have to be over the age 70 and a half. A DAC, I'm wondering if they mean a donor advised fund, DAF, is how I'm interpreting that. And the donor advised fund was the tool here where you put the money in and then you get the deduction in that year, and then you can make the deduction in a future year. Unfortunately, you are not able to do a QCD into a donor advised fund. The IRS requires that the QCD, one of the stipulations is the money comes out of the IRA and goes directly to the charity of your choice at that time. So because of that, you're not able to put that money into a donor advised fund. So you would use one or the other, but you can't use both in that scenario.
Yep, and I mean, I think for clarification, I think that the DAC is similar to DAF in a decentralized autonomous charity, but I think it's a very similar vehicle.
Okay.
And with that, so I did get another question that came in is when you mentioned cash, does that include clothing and other types of household donations?
Are they saying,
So
go ahead, Sean.
Right. So it would not be considered a cash gift if you're contributing hard goods such as clothing, etc. You would receive a deduction based on an appraised value. So that can either be self-reported if the gift is under $5,000, but if it's over $5,000, the IRS requires that an actual appraisal is done on that item to substantiate the deduction amount that you're taking. But it does not fall in the cash category.
Great, thank you so much, Sean and Paul. That was the last question I had today. So again, in closing, I'd like to thank everybody for your attendance today. Again, we do have a 1 to 2 minute survey. It's in the chat box. You will all get an email tomorrow from us, as well as an automated one from Zoom that includes links to the PDF slides as well. So if you missed them in the chat box, just pay attention for that email from us tomorrow. And you will have information regarding the replay and other resources available from BFSG. With that, let me thank Sean and Paul one more time for their presentation today. Thank you for joining us, Sean from Schwab Charitable. And I hope all of you have a great day.
Thank you, guys.
Thank you.